Well, homeowners with expiring mortgages are now facing a difficult choice as interest rates remain elevated. Renewing an existing mortgage involves updating the contract with the new interest rate, or refinance. That involves breaking the current contract and then signing a new one, allowing the borrower to extend their amortization period, leading to possibly lower payments monthly. Leah Zlatkin, a licensed mortgage broker and also a lowestrates.ca mortgage expert, joins us now live this morning. So, Leah, we've got you on here because tomorrow, of course, the Bank of Canada is going to make its latest interest rate announcement. There seems to be a fairly solid consensus. We won't see a rate hike. What are your thoughts right now about what's going to come out of Ottawa?
As of right now, most analysts are predicting that we're going to hold, so we're going to see the rate stay steady. The reality of that is that the next question we need to ask ourselves is, how long is this going to last? How long are rates going to stay high? It's my prediction that rates will stay high for about 6 months, at least after this, maybe up to a year. So if you do have a variable rate mortgage and you've got a longer term left, so maybe you've got 2-3 years left in your variable, and you're willing to wait and ride out that storm and see the rates going down, and you might be able to get that advantage, perhaps it's the right time to stick with your variable. If you're struggling right now and you have a shorter amount of time left on your mortgage, it might be the right time to finally make that decision to move into a fixed rate mortgage.
Now, if you have the plan or the idea, you're kind of alluding to effectively breaking your mortgage and sort of restructuring again, what kind of a penalty could people expect to pay on that?
So with a variable rate mortgage, the penalty is typically 3 months interest. So whatever your interest payments are, look at that, multiply it by 3, and that's typically what your payment will be.
Okay, and so what you're sort of saying there is likely over the longer or even maybe the shorter term, paying that would be cheaper than paying the inflated potential interest rate.
If your term is shorter, so if you've got less time left, you're not going to be able to have the advantage of time in order to ride that rate down, especially if the rates stay elevated. So at this point in time, if you're really having trouble paying those payments, it's time to think about a different solution.
And would you then suggest going back into another variable rate mortgage, expecting that maybe in 6 months the rates may start going down, or would you? What's the sort of strategy these days?
I think that's a strategy for somebody who's very interested in pursuing a risk strategy. I think that for most people who are comfortable Canadians who want something that's offering a little bit of security, most people are going with 3-year fixed products. I don't feel that a variable product is a safe bet for somebody who needs a fair amount of certainty.
It's interesting because we kind of found out in the last year or so, as the Bank of Canada went into this interest rate hiking period, just how many people were in variable rate mortgages. I think it was I locked in because I got what I thought was a pretty low rate, and I'm very happy that I did based on what's happened here. But you're the mortgage broker here. What is sort of generally the breakdown between the fixed versus variable?
So previously, a lot of people were getting variable rate mortgages. Now, there were 2 types of variable rate mortgages. So there were variable rate mortgages where your actual payment amount changed, and there were variable mortgages where your payments did not change, where your payments remained consistent and the amortization lengthened. A lot of people viewed that as the safer bet. And so a lot of those people who did view that as the safer bet are now going to be experiencing problems at the end of their term when they have balloon payments or when their product has amortized out over a longer period of time. So that was the safe bet before. Now the safe bet is a 3-year fixed.
And it's interesting, you talked in your initial answer about, maybe 6 months and then maybe interest rates will start going down. The Bank of Canada, though, has signaled that they won't hesitate to increase them again here. How worrying is that?
Well, it depends on how inflation goes. The last inflation report showed that inflation has actually gone down. It was below the 4% mark, so that's actually really good for us. The challenge here is that in the United States, the inflation is still really high. And so because we sort of follow along with what the U.S. is doing, if they can't get inflation under control, we may see rates go up again just to sort of follow pace with the U.S.
Right. Okay. So much to follow, and we'll see what happens with the Bank of Canada tomorrow. Leah Zlatkin from lowestrates.ca. Always appreciate it. Thanks so much.
Thank you so much.